Hey guys, welcome back to Sky Talks Trading. My name is Sky and I am on a quest to invest. Today, going to be talking about SoFi Stock again, and also at the end, if you stick around, I'm going to be talking about two oversold stocks that could be ready, nice and primed for a comeback. I'm not a financial advisor, but I like to talk about finance. So as you know, there has been a lot of talk lately. It's the talk of the town, if you will, about SoFi getting the bank charter. It was something we were waiting for a very long time. And then when it finally happened, it almost felt too good to be true, but it was in fact true. But now, once the excitement levels have died down a little bit, we kind of want to talk about what it really means for SoFi and for the future. There's obviously a reason why SoFi became a bank. First, the bank charter allows SoFi to bring all the deposits that it has been gathering through its SoFi Money cash management account into the company, because non-licensed banks can't actually hold deposits insured by the Federal Deposit Insurance Corporation. Then SoFi can use these deposits to fund a portion of its loan originations, which will obviously save it money because SoFi has been relying on higher cost funding sources. Having the bank charter will also give SoFi better regulatory clarity and set up a better framework for holding loans on the balance sheet and collecting recurring monthly interest payments. At the very beginning of last year, of 2021, SoFi showed that having a bank charter would increase earnings before interest, taxes, depreciation, and amortization. The abbreviation for this is EBITDA, by close to $200 million this year, and as much as $300 million in 2025. And yeah, sure, things may have changed since then, but clearly SoFi sees this as a win. Now, on the other hand, becoming a bank means SoFi is entering one of the most heavily regulated industries. Banks in the US typically answer to three different regulatory agencies. So firstly, they have the Office of the Comptroller of the Currency, which is the OCC. Then, of course, they have the Federal Reserve and the FDIC. Banks must hold regulatory capital, which ensures they can cover, any unexpected loan losses and continue to lend to individuals and families and businesses during any economic downturn. So it's not exactly a walk in the park. It's serious business, this bank charter stuff. So whilst we don't actually know yet for sure what SoFi's regulatory capital requirements are, the OCC said in its approval of SoFi's banking charter that the company, and I quote, shall have initial paid in capital of no less than $750 million contributed in cash. So SoFi is expected to have $5.3 billion of assets upon completion. That would equate to a tier 1 leverage ratio of more than 14%. While that would be high for a bank, it wouldn't be that surprising if you consider Lending Club, which is another fintech that became a bank last year. They have a leverage ratio requirement of 11%. So how will SoFi be valued? If you look at the recent prices, SoFi is being valued as a high growth tech company, with investors awarding it a nearly $10 billion market cap without any profitability yet. That's pretty impressive. The idea is that SoFi is building a big base of high income members that will be able to monetize heavily down the line. So for now, kind of putting profits out of the picture does make sense. But in addition to earnings, banks also tend to trade based on their tangible book value, which is TBV for short, which is what a bank would be worth if it were, let's say, liquidated. So if we look at SoFi's valuation compared to some of the most highly valued and tech-forward banks in the industry, let's just have a little look at this table. We've got, first of all, American Express, which has a PTV, or a TBV, of 630%, and the price to earnings is 18.2 28.44. And return on equity in 2021 is 33.75%. And then we've got Triumph Bancorp, and their TBV is 407%. Price to earnings 19.95, and return on equity 15.11%. So these are two on the higher ends, and then on the other end of the scale, we've got Silvergate Capital with a TBV of 206%, price to earnings 36.29, and return on equity 8.61%. So then right in the middle here, we have SoFi Technologies, which with a TBV of 339%, price to earnings non-applicable, and return on equity non-applicable. So we don't actually know, but we can definitely get a sense of it by looking at the table of these other banks in the same sphere. So as you'll notice, SoFi already trades at more than 3 times its TBV, which falls in the middle of this group of top bank stocks. And you might be thinking to yourself, well, that makes sense because SoFi is much more innovative than a traditional bank. Lending Club in particular is an interesting example of the struggle because it is a fintech in the lending space that secured a bank charter last year. The charter has done wonders for the company in terms of profitability, but it has led the bank to increase equity over the past year to support future growth. And investors seem to be struggling over how exactly to value it. After Lending Club management implied less growth than anticipated in recent guidance for the year, the stock got absolutely crushed as investors seemingly valued it more like a bank. Yet if you watch daily trading activity, Lending Club continues to move with fintech companies like SoFi, Upstart, and Affirm. So it'll be very interesting to see where things go from here. So as promised, I'm going to give you guys 2 undervalued two oversold stocks. First, we have PJT Partners, and the ticker for that is PJT. It was founded in 2015 by Morgan Stanley's Paul Tubman, and it's quickly become one of the industry's most prestigious investment banking and advisory institutions. The company has been involved in mergers and acquisitions worth a combined $600 billion plus in its short history. That's just since 2015, which is very impressive. One of those was the $59 billion T-Mobile Sprint merger in 2020. While the firm is consistently profitable, its shares are down by 30% from the peak that they reached this past October. So that is quite a nice discount. In 2H21, the company has shown revenues and earnings that are down year over year. Management described 2020 as an extraordinary run-up in reference to the firm's business and described 2021's environment for the firm's core businesses as a challenging market backdrop, obviously. These comments came in the context of the Q4 21 report, which showed top-line revenue at $313 million, down 3% year over year. EPS at $1.52 was down 16% year over year. In line with the company's historical pattern, Q4 showed the highest quarterly results of the year. For the full year 2021, revenues came in at $991 million. At the same time, despite the drop-off at the top and bottom lines, PJT saw fit in Q4 to raise its common stock dividend. The payment, which had been set at 5 cents, was quintupled to 25 cents per common share. At that rate, the dividend annualizes to $1 and yields a modest 1.5%. The key point here to consider is not necessarily the yield, but the large jump in the payment. 5-star analyst Jim Mitchell writes that he remains bullish on PJT, including among his reasons, 1, given a greater confidence that restructuring revenue has bottomed, investors now have positive optionality should higher rates, supply chain distributions, etc., create more restructuring opportunities. Mitchell definitely believes that the stock is worth holding on to. He rates PJT shares a buy, and his $94 price target suggests a 49% upside potential. The average price target amongst analysts is $91.50. So the next oversold stock I want to talk about is CalAmp, which the ticker for that is CAMP. CalAmp deals in connected intelligence, applications, hardware, and cloud computing that make IoT function, Internet of Things. The company's products, from edge computing devices to subscription-based apps in vehicle tracking and management, have found niches in corporate fleet and supply chain administration. They boast over 1 million software and services subscribers and more than 20 20 million installed devices worldwide. But at the end of December, CalAmp's stock fell sharply, dramatically accelerating a more gradual decline from the previous several months. For the past year, the stock is now down 50%. Shares are priced at $5.67, and the average price target amongst top 5-star analysts is $11.24, which implies a 1-year upside of 30%. So there you have it, guys. Let me know what you think in the comment section below. Don't forget to subscribe because I talk about stocks and finance and investing. And if you're watching this video, you probably love all of those things. So thank you so much for watching, guys. And until next time, have a great day.